Good afternoon, everybody, and welcome to the latest event in our series of professional advisors working lunches. Today brought to you courtesy of our partner, Baillie Gifford. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It will ensure there's no background noise so the speakers can be heard more clearly. I should also inform you this session is being recorded and we'll send you a link of the recording by tomorrow. Of course, do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending your proof of attendance along with the link to the recording of the session, which should arrive in your inboxes tomorrow. So today's session is called Why Growth Investing Still Matters for the Long Term. Since the turn of the year, a number of events and tragic crises have given rise to a very uncertain environment, and investors are understandably left without much optimism. Growth investing has had an especially difficult year so far, with the apparent safety of value investments being more alluring. Baillie Gifford would ask and try to answer whether this flight to safety is founded in a genuinely long-term outlook. So with that backdrop in mind, I'm delighted to be joined today by Baillie Gifford's Philip Scott, whose client serves as manager with the Baillie Gifford Managed Fund. Over the next hour, I'll be talking to Phil about the fund's recent performance, the firm's approach to long-term thinking, and ultimately address the question of whether, in this environment, it's still possible to achieve superior returns from growth investing over 5 years and beyond. Of course, do feel free to put any and all of your questions to Phil using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message. That way, only I can see it. Before I hand over to Phil, let me quickly run you through our learning objectives for today. By the end of the session, delegates should be able to understand the managed funds investment process, be able to state why a focus on the long term is vital for client outcomes, and understand why the current environment still leaves room for optimism for the investor willing to take a long-term view. So that's the CPD covered. Let's hear from Baillie Gifford's Phil Scott. Good afternoon, Phil.
Thanks, Tom. Good afternoon, and good afternoon to everyone. Thanks very much for joining the call today. As Tom said, I'm Phil, an investment specialist on the Baillie Gifford Managed Fund. I work closely with the fund managers, as well as servicing managed fund clients directly. And it's a pleasure to be able to join you today. And thanks for giving up your lunch break. I want to start today by acknowledging what I think will be front of mind for everyone, which is the extent of weakness that we've seen recently in the managed fund, down about 26%. Over the last 12 months, well behind its peer group over that short period. And we know it's been a very difficult time, especially for those who have been invested for shorter periods. But it's uncomfortable as well for longer term holders. And we're very mindful of that. And I'm sure it'll be leading to tough conversations with your clients. But I hope that today you'll go away feeling better equipped for meetings with them and reassured about how we're thinking in the face of this very tough period of short-term underperformance. In terms of the structure, I want to take the next 15 minutes or so to discuss what has happened performance-wise, the reasons for it, what we're doing about it, and our outlook from here. So let's tackle that first question, what's been going on? Well, the environment we're in, it's not unique necessarily, but it's very different to what we've all been used to for some time. We have the worst inflation we've seen for 40 years plus, very pronounced swings in markets from day to day, and a mixture of ongoing question marks around how all of these varying uncertainties and crises in the world will resolve. And it's against that backdrop of many and various headwinds that 20% of UK funds have experienced their worst ever performance drawdowns. So clearly we're living in a very tough time to invest, and more importantly, a tough time for savers, such as your clients and you yourselves. And the managed fund has been far from immune, clearly. Our growth style of investing has been especially out of favour. Now, for some historical context, the fund has delivered a positive return in about 80% of 12-month periods in the last 35 years. And what you'll see on this slide, I hope, hopefully you can now see that slide in front of you. And what you'll see here is that as you expand your time horizon, that percentage rises and the range of returns narrows on the positive side, such that to the end of March this year achieved a positive return in 95% of 5-year periods 100% of 10-year periods. And that's what we're trying to achieve for you and your clients with this fund. Our objective is simple but not easy. It's to achieve capital growth over rolling 5-year periods. But we know that many people don't have the benefit of long-term returns behind them, and the recent weakness has been especially pronounced. As at the end of June, it'll likely be the worst 12-month period that we've seen in the fund's 35-year history. Now, this fund holds about 200 equities, 130 bonds, there or thereabouts at any one time, as well as an allocation to cash. And the question many people very understandably have is, why has it been so volatile over the last year or so if it's so diversified? Well, the first thing I think to highlight about the recent weakness in the managed fund is it's been broad-based across the portfolio. It's not just a handful of holdings that are dragging on performance, but it's the majority. And it's not just one factor that has impacted returns, but that combination of headwinds that I mentioned, and I'll come on to more specifically. And it's impossible to pinpoint a precise reason for each percentage point of underperformance. But there have been some especially strong headwinds, and the most prominent of those has been rising interest rates and inflation. Now, the fund is invested, this fund, in predominantly growth equities, typically around 75%. And these are companies which we believe will grow earnings faster than the benchmark and therefore grow in share price terms. And we think they will be the key driver of our long-term objective of achieving capital growth over rolling 5-year periods. But in most cases, the equities in this fund, the growth equities, and their cash flows are long duration. They're quite a long way into the future as opposed to being immediate. And they are therefore particularly sensitive to interest rates and inflation, because those two things make cash flows, future cash, less valuable. So the market will often believe that from today's starting point, those companies as a whole are worth less. Now, it's not to say that's necessarily a wrong way to think. Some people may feel they can generate good returns by using that sort of philosophy, but it assumes a continuation of the status quo. Whereas in many cases for the holdings in this fund, they're growing earnings very strongly. And indeed, they're growing their earnings in aggregate at the fund level faster than the index. And where we believe we have an edge is assessing the long-term opportunity. It's not about what if. It's not about what is, a bigger pardon, it's about what if. It's not about what's going on today, but what could the future look like? And that is what will ultimately drive share price outperformance. And it's the consistency of a growth-focused approach that has allowed us to deliver good outcomes for investors over 35 years, and indeed over 5 years plus. But nevertheless, in the short term, the higher interest rate and inflation environment has had an indiscriminate effect on the types of companies we're specifically looking to invest in on behalf of you and your clients. And compounding that issue has been this flight to safety, or the perceived safety of big companies in mature industries with stable cash flows today. And there has been safety in those businesses. You know, we've seen that over the last 12 months. Value, and we were seeing this in 2020, that, you know, value at some point is going to have its day in the sun. And indeed, that's happening now. But are these sorts of companies, and we're talking about companies like big oil, high street banks, etc., is that the place to be for long-term growth? We would suggest that it's not. So that's the first major headwind that's faced our style of investing and has led to these pretty indiscriminate falls. The other major one is a market-wide concern around a slowdown in growth, global economic growth, and in the growth of businesses that saw lots of it over the last couple of years through the pandemic. And the question is ultimately, has all of the future demand simply been pulled forward by the pandemic and there's not much to go for from here? And some of the weakest performers in the managed fund over the 12 months to end may fall into that bracket. Shopify, the e-commerce platform, is a good example. Of all of the holdings in the fund, has been certainly a top 5 detractor over the last 12 months for the last little while. Now, clearly the pandemic drove consumers online and therefore also retail outlets online. And so there was a big acceleration in online shopping, and Shopify it builds the building blocks, if you like, the platform on which small, medium-sized companies can create an online presence. But it might surprise some to hear that in the US, for example, about 80% of retail sales are still offline. And so to say the opportunity has gotten drastically smaller would be untrue. And in fact, Shopify could be quite early in its growth journey, and there's still a huge amount to go for. But the share price has been exceptionally weak. There's a concern around growth slowing. But connected with that, what we've seen with the share price of Shopify and many other holdings across the portfolio has been a sentiment-driven market. That's what's been connected with a lot of this share price weakness, rather than being dictated by actual operational progress at companies. Now, Shopify saw extraordinary growth in revenues in 2020, and I don't think anyone was expecting, us included, those to continue at that level. But its most recent results announcement was actually very positive. Revenues up about 22% on the back of that extraordinary growth. So a very tough comparative period the year prior. And you now have a business that is 3 times larger than it was pre-pandemic, and yet the share price is round-tripped. And in addition, Shopify is choosing actively to forgo earnings today, investing in its business to cement its position in the expectation that that is what will pay off in the long term. I studied business and finance at university, and I remember one of the early lectures, they defined investment. I mean, there are many ways you can define investment, but a definition is the foregoing of current consumption, or maybe you could say current profitability, with the expectation of long-term gain. That's what actual investing is. It's foregoing current consumption with the expectation of something better in the long term. And that is exactly, therefore, the type of behavior we like to see from growth businesses. And it's just one example. There are others like it, of where share prices have been really weak, despite genuine operational progress. That market-wide disconnect has hit companies in this fund pretty hard. So those are the major headwinds, and there are others which we can come on to perhaps in questions, but those have been exacerbated by the Russia-Ukraine crisis, concerns around Chinese regulation, as well as disruption caused by lockdowns, which are still very prevalent across a lot of Asia. So it really has been something of a perfect storm for growth investors. Just lastly, perhaps on the performance weakness, not so much a theme, but I think we need to be upfront that some things don't pan out as we hope they would operationally. Some companies are having a tougher time. An example would be Peloton, the sports company. They've made some mistakes operationally, I think it's fair to say. And we've been meeting with management to discuss those and try and get a better grasp of what lies ahead. But we know we won't get everything right. And that's ultimately par for the course when it comes to active investment management. And I can come on in a moment to an example of where an investment case is broken as a result of what's been going on. I think it's worth mentioning quickly too that there have been some pockets of strength in the portfolio. We have companies in this fund, particularly with very strong pricing power, thanks to their competitive position. A company which I suspect most of you are not familiar with is IMCD. It's a specialty chemicals distributor based in Rotterdam. And it's been able to pass on the cost of inflation to its customers and grow quite nicely organically as a result. And it's therefore held up quite well. Others are exposed more directly to rising prices. So price inflation. Petrobras, the oil company, is one that's benefited from rising oil and gas prices. But clearly, over the last 12 months, those positive performances have been outweighed by the weaker ones over the last 12 months. Now, just before I tackle the what are we doing section, I mentioned earlier that how diverse a fund this is, and the question of how it could be so weak with 20% or so in bonds. Now, one of the roles of bonds in this fund alongside return is balance versus equities. And we have a rule of thumb, a beta of 0.25. That's a beta of fixed income to equities. And that's something we monitor. So we know they're not going to be a perfect hedge versus equities. In other words, that 0.25, meaning they do move in the same direction. It's a weak positive correlation, if you like. We know it's not a perfect hedge, but we do expect bonds to offer some balance. And we've run the numbers to see if that's been the case. And the answer is yes, albeit the extent of equity weakness means that it's pretty hard to see. The bonds were down, the bonds in the managed fund about 2% over the 12 months to end May, versus the fund which was down about 20% over the same period, driven by that weakness in equity. So they have offered balance, but in these sorts of extremes in equity markets, which make up 75, equities make up 75% of this fund, it can be difficult to see that balance coming through. So those are some of the reasons, some of the headlines for the weakness that we've seen. But importantly, what are we doing about it? Well, firstly, we've been taking a step back think the last thing we want to do is say the market's simply wrong and everything's fine. So we've been assessing holdings on an individual basis, particularly around their ability to weather inflation and remain agile through a period of uncertainty. And of course, answer that question of whether we believe our investment case still holds together as a result of ongoing challenges. And that work has shown, and I'll share this slide, which I hope that you'll see clearly. That work has shown that in aggregate, at the fund level, holdings are growing their earnings faster than the index. They're less indebted than the index. And that's what the right-hand chart shows, earnings on the left, indebtedness on the right. And they're also investing more for future growth than the index, which you'll see in that chart in the middle of the page there. So we've been reassured from our ongoing analysis that the quality of the portfolio remains high. The operational progress is there, and we think that holdings are well placed. In some cases, though, that work has highlighted companies that might struggle in the face of ongoing challenges. An example is Wayfair, the homewares retailer listed in the US. As interest rates rise and consumers are squeezed, it's certainly feasible that Wayfair sees a hit to its revenues, at least in the short to medium term. And on the back of that, we trimmed the holding size last quarter, reflecting what is now a slightly tempered view on the outlook from here. Albeit online retail is still an area that we're, broadly speaking, enthusiastic about. In other cases, we're simply watching for now. One area that may or may not be affected by consumer squeeze is streaming services and a willingness to pay. Some people would suggest this would be one of the first things to go in a consumer squeeze. I've read elsewhere the evidence suggests that they're some of the last things to go. So there's an uncertain future for companies like Netflix in the managed fund portfolio. Now, it still has other avenues for growth from here, and we think there's still likely to be a continued move away from traditional cable TV, and I don't think that's necessarily in a huge amount of doubt. But that's a company we're watching closely for now on the back of some slightly weaker results. And in some other cases, our ongoing assessment of holdings might lead us to believe the investment case for a business has been undermined, it's broken, and so we'll sell out. And Vroom, which is a platform for selling used cars online, is one example. We felt this company was already struggling to cope with supply chain disruption. You'll be perhaps painfully aware if you've tried to buy a second-hand car recently. Inventory is quite tight, and Vroom has had to make some changes to its business model, and it's in a slightly more precarious position in terms of its balance sheet. And we felt the investment case there was undermined, so we sold that holding in its entirety. But the rigorous assessment of upside from here will sometimes, and often does, reinforce a conviction in a company's prospects. And Auto1 would be a very recent example. This is a German company that sells used cars online. And we felt it's been very unfairly punished in share price terms. So we've been adding to that holding. We added in the most recent quarter, and indeed to other places where our holding, our conviction in a holding has strengthened. That may sound like we're being busy in terms of buying and selling holdings, trimming and adding and that sort of thing, but turnover in the fund remains low, an average holding period of 8 years or so, in line with our very long-term approach. So for us, it's about seeing holdings for what they are. These are real-world businesses that we're taking ownership stakes on your client's behalf. They have their own strengths, unique circumstances, unique challenges, so we need to take each one on a case-by-case basis, and that's what our active investment approach really is all about. But just to finish, what now from here? And the honest answer is that we don't know where markets will go next. I wish I could give you a date that we're going to see this big bounce back, but we don't feel we have an edge in predicting macroeconomic trends. But our question from here is, as I mentioned earlier, it's what is, not what if. And we believe there are still myriad opportunities for the long-term active investor. And that's perhaps the most vital point I can make as I finish up. The temptation at times such as these is to chase returns. In other words, it's to shorten the time horizon, look for some certainty, and invest in something a bit more certain and invest accordingly. But we're not going to do that. We know that style drift is destructive for shareholders and would do more harm than good in the long term. So we've made an active decision to stick to our process. And it's a process that is focused on periods of 5 years and more. And I'll just share this final slide with you. And what you'll see on this slide is that the managed fund has been around now for over 35 years, and in that time has experienced various downturns, from Black Monday to the tech bubble to the GFC. And what added value for clients in the long term was to stick to our knitting. It was to maintain a long-term view and to stick to what we do best, where we have an edge. That's worked over the last 35 years. It's an approach we still believe is fit for today. Now, clearly there are limits to our predictive abilities, and we need to be upfront about that. But what we can focus on are the opportunities presenting themselves across the globe for long-term growth. We believe that the structural drivers of progress, like the intersection of IT and healthcare, cloud computing, the energy transition, these things have not gone away. And this fund remains a hand-picked selection of the companies we think offer the best opportunity to add value in the long term, and many of them are geared into some of those structural trends. And we think that can happen too, regardless of the macroeconomic environment. We don't actually need global growth to add value for clients in this fund. You know, when you've got companies that are growing their earnings, I mentioned Shopify, but companies that are growing their earnings well into the double digits. And we think that actually, even in an environment, let's say, where inflation lingers a little bit higher for longer, these companies are still well placed to add value on a 5-year plus view. And it's on that basis that we're optimistic about the future from here, and the opportunities for the investor willing to take a long-term and growth-focused approach. So that's all I wanted to say, Tom. I'll maybe hand back to you and we can get into some questions.
Thanks, Phil. I can see everybody's questions coming in, and do keep popping them along, but for a few minutes I'm just going to ask Phil some questions of my own. So first up, Phil, your graph at the end was quite interesting, I think, with the, since inception, how the fund's done. Obviously, it's been quite impressive performance, but the kind of 1989, 1990 was the last time we saw significant, or 5% plus inflation in the US. And how do you think you will perform in an inflationary environment, given the managed fund hasn't really existed before in that kind of space?
Yeah, I think that's a really reasonable question, Tom. I mean, I think what's really important from our perspective, maybe firstly, is to say we don't think we have an edge in predicting where inflation will necessarily go next. We do have a view, a kind of broad view that it's probably here to stay a little bit higher structurally over the long term, but is likely to come down overall, certainly from where it is just now. But your question is a good one. And I think, so what I mentioned earlier really applies, that the companies we're invested in are ones that are growing their earnings far, far faster than the index. And over the last, albeit we've not been in an inflationary environment, albeit over the last 30 years, actually it's earnings growth that has delivered share price performance. That is the main fundamental driver of share price performance. And we don't have reason to believe that in this environment, that relationship fails to exist. I think though too that the companies in the fund are growing their earnings very, very strongly, and therefore even if inflation were to linger a little bit higher, and as I say, we don't necessarily know where it's going to go, but even if it were to linger a little bit higher, we think actually the companies in the fund are making genuine operational progress, and that will ultimately be reflected in share prices. I think the other thing that's interesting too, inflation poses some challenges to companies in terms of cost increases. But Ian McCombie, who's the co-lead manager of the managed fund alongside Stephen Hay, I was at a meeting with him yesterday, and he said something really interesting, which was that equities are a warrant on human ingenuity, and you bet against that at your peril. And I think actually what we've seen companies do in times where costs increase is ultimately innovate to work to become more efficient. And actually, they'll hopefully, we think, wrestle with that challenge quite well, particularly as they invest for the future. These companies, I mentioned Shopify a few times now, but these companies are in the habit, they're culturally aligned with the idea of investing for the future. And so we think they're going to be well positioned regardless of an inflationary environment. It's not to say it won't pose its challenges to individual holdings, but at a portfolio level, we think as long as the earnings growth comes through, then we're likely to see share price performance follow.
And in terms of an inflationary environment, whether it's significant or not going forward, significant or just, more than we've seen over the last 20 years or so, do you think that will be the biggest barrier for outperformance for Baillie Gifford and growth style investing in general, or do you think there are bigger barriers potentially there?
Yeah, it's an interesting question. I mean, I think inflation clearly, I mentioned that clearly inflation devalues future cash flows. The other thing is, of course, increased rates. And some of you'll be aware that for some, it's a case of plug in a higher interest rate, i.e. discount rate, and on a discounted cash flow basis, that's how a company could be valued. And we think that sort of model is a very short-sighted way to think about investing. If you'd used that approach for, let's say, an Amazon 20 years ago, you would have been sorely disappointed. Because I think what's often forgotten about these companies is the status quo is not likely necessarily to continue. In fact, it's probably unlikely to continue. And maybe pulling another example would be Moderna. It's become a household name, long-standing holding for us as a firm, but it's become a household name. And I think it seems that the market believes its mRNA technology makes it a bit of a one-trick pony. And actually, you just kind of project from where we are now and devalue cash flows at whatever rate of inflation you think we're going to have. And actually, mRNA technology, call it a one-trick pony if you like, but the amount of applications for that trick are just vast and, quite amazing in terms of the opportunities for tailored healthcare, where you might give a blood sample 1 week and get tailored drugs for your genetic code the following week. Now, if inflation is at 5 or 7%, is probably, we think, irrelevant to whether or not Moderna is likely to see that kind of growth come through from all the other applications. And that's true of holdings across the board. Now, if it settles in, let's say, if it was to settle in the high mid-teens for a long time, who knows, maybe the opportunity set changes slightly. But we've got right now the view that inflation is likely to be, as I say, structurally a little bit higher than where it is now, but is likely to come down. And in any case, when a company is growing its earnings at 20, 30, 40+%, it's likely to weather that environment pretty well.
And in your presentation, you managed diversification and the use of bonds. And I think the managed fund, I believe, is around 75 to 80% equities. Correct me if I'm wrong there. But, for something that's called a managed fund, it's quite high. Do you think that will change in the future? Do you think you'll be less weighted towards equities than you are now, or where do you see that going?
Yeah, I think if anything, just now, to be honest, Tom, speaking to the equity managers at some of our most recent meetings, there's actually a palpable enthusiasm among the equity managers. So in terms of the allocations between equities and bonds and cash, there's a policy setting group that meets at least quarterly, has been meeting a bit more often, just given the extent of volatility. And that group ultimately meets to decide on the allocations to those 3 asset classes. But it's very much driven by our key strength, which is bottom-up stock and bond picking. Now, the last time that group met formally, there was a real notable enthusiasm coming from all of the underlying managers, the individuals responsible for the regional portions of the managed fund. And what that led to was actually an increase in our target in equities. Now, I've talked about some of the reasons for equities actually being a good place to be, particularly high growth equities in an inflationary environment. And I suspect certainly the mood music for now is there's still a fair amount of enthusiasm for the companies. And we're looking at companies and seeing genuine, meaningful operational progress, and yet the share prices are coming down. And we have no reason to believe that we should be reducing those companies. If anything, if that pattern were to continue and we saw the operational progress coming through, we'd be more likely to add than we would be to reduce. So certainly our strategic allocations of 75% equities, 25% bonds and cash. We've got 10% bounds either side of that we can go up or down, but no reason to suggest that we'll see a big decrease in equities in favor of bonds or cash anytime soon. But there's also enthusiasm come from the bond managers. We've got to hold these things in tension, and the cash is there to offer some option value. So that if the individual managers are enthusiastic and they'd like more cash, then we can reflect that at the fund level.
And do you think that will change if there is a stronger inflationary environment than you anticipate? I know I keep bringing everything back to inflation, but that's kind of the cloud we're all living under at the moment. Do you think that you have to see greater diversification away from equities if there is greater inflation than you expect, or how do you see that kind of relationship going forward?
Yeah, I think for us, growth equities are probably a relatively good place to be in a higher inflation environment, in all honesty. Now, the other thing maybe to consider is within bonds, we might slightly tweak our opportunity set. We have been a bit more enthusiastic about, for example, high yielding credit rather than investment grade, because those high yield has typically been a better place to be in a more inflationary environment. And likewise with sovereigns, marginally more enthusiasm for EM bonds, for emerging market sovereigns over DM sovereigns. Those many countries in the emerging market world raise rates pretty early, places like Latin America, to stave off inflation. So we might see within the bond portion, for example, a little bit of realigning according to that. But from here, we don't know where inflation is going to go. We don't think we have an edge. We see real positive operational progress at companies, and that's what we're going to back. And we think that actually, that is a good place to be in an inflationary environment.
And my last question on inflation, just for the moment. You mentioned emerging markets there, and obviously it's a global fund.
Yeah.
Inflation isn't rife everywhere across the world. So how do you see that kind of relationship in terms of picking great stocks on geography? Stocks on geography. How do you see that working when there's different inflationary pressures that are acting differently in different continents or areas?
Yeah, sure. Well, one thing we know that clients that typically investors in the managed fund is that it offers balance across regions. You might have heard it in the past described as a one-stop shop to our best ideas in regional equities and global bonds. And each of the regional equity portions that is in essence bolted together to form the managed fund is managed autonomously. So that's maybe the first thing to say, is that Ian McCombie, let's say, is responsible for the UK portion, is not necessarily at the managed fund level choosing companies based on what's going on in the US or EM or elsewhere. So each portion is choosing within its opportunity set. So maybe that answers the question on its own in some ways. I think the other thing that I would say is we're active stock and bond pickers. So we're not buying an index, we're not buying a country. We're buying individual companies that we think can grow earnings ultimately in the long term, and in many cases, they will be, it might be a company, let's say it's listed in the UK, but it might make more of its revenues in the US. So it's difficult to look at a listing or the breakdown based on where a company is listed in the managed fund and therefore ascertain the inflationary effects. It's very much intermingled. But from our perspective, it's back to that company focus on companies, individual countries in the case, of course, of sovereigns. But it's that bottom-up stock research that we think we're best at, and we'll continue to do that. And inflation will have its challenges and benefits for some. Touched on some companies that will benefit probably from that environment. But it's coming back to those fundamentals for us every time.
But being fundamental and bottom up, there must be external pressures outside of the companies that affect how they run. How do you kind of balance whether you love a stock within the environment is working, whether that's geographical or economical?
Yeah, it's a really good question, Tom. And we have got to consider that a company, obviously it's operating in an environment, and its environment will, each company will have its own unique challenges according to the environment it's in. I mean, we will always be assessing, firstly, what is the opportunity for this company? Sometimes that will be a global opportunity. In other cases, for example, China, it might be more focused on the domestic environment. But we are definitely considering that, and then coming back to the management team's ultimately expertise and their ability to execute on that opportunity. So for sure, the environment will pose its own challenges. I mentioned Wayfair earlier. If consumers are squeezed in the US, here globally, then that's likely to have certainly to hit the top line of some of these more consumer discretionary companies, that are more reliant on discretionary income. Others, Netflix, which I mentioned, streaming. So yes, maybe these things will have an effect. But coming back to our not having an edge in predicting macro trends, I think we've just got to be resolutely focused on what we do, and it's bottom-up growth, active company picking. And that is what we will continue to do, because it's how we think we can add value. But it's taking that external environment and everything else and all the other nuances that come with an individual living and breathing company.
And you touched on this a bit during your presentation at the beginning. But sorry, I forgot where I was. I'm gonna ask a question from the audience instead. We've got a fair few through, so probably jump onto those pretty sharpish. I've had one through directly to me, and it says, why did you not consolidate gains at the end of 2021 when the warnings were there for a global downturn?
Yeah, it's an interesting question. I mean, in hindsight, that would have been a great thing to have done. Things were at kind of all-time highs in some ways for many companies, and we'd seen extraordinary growth. I think, though, for us, and I touched on, online retail as an example. I think pre-pandemic, the research I looked at in about 2019, online retail was about 15% of the market. In other words, offline was about 85%. That figure looks now to be closer to 80. Now, you would think it would be far, far higher in terms of the online share. But actually, there's still a huge amount to go for. We're seeing applications, for example, of mRNA technology, which I touched on for Moderna, which are really just opening up. And the opportunity is just beginning. Now, I think the other thing that was quite challenging in 2020 is clearly there was a bit of sentiment on the upside. And I wouldn't like to sit here and suggest that all the strength in 2020 was skill and all the downside over the last 12 months has been luck. There's going to be a bit of luck on the upside as well. And at those stages, we're always coming back. And it's interesting because there's a parallel here to what we were doing, which is going back to our forward-looking hypothesis for a company. Can this company still meet our long-term growth hurdle? And if the answer following analysis is yes, then we'll continue to hold. Now, an example would be the US team. They've got a growth hurdle of 2.5 times share price over 5 years. And that's pretty punchy. And there were times that we have trimmed holdings on the back of that, and mindful that a company like Tesla being perhaps the obvious example, it was up 700+% in 2020. And actually over the last 12 to 18 months, we've trimmed Tesla several times on the back of that strength. So it is something that we do on the back of our ongoing analysis. But, ultimately, if we believe the investment case is intact, we won't trim a holding as much as sometimes in hindsight, it might look like we've had the timing wrong. And Tesla's maybe an example of a company which, despite everything it's been through and a bit of a rollercoaster ride for shareholders, it's still, we think, an incredible growth opportunity. So I hope that helps just in answering that holding those things in tension of yes, strength, but think about the long term, still 5 years out.
And then another question says, clients now see quarterly valuations and try to micromanage their funds, and so looking to the short term with little patience is often what they do. How do you see the next 12 months of the fund going?
Yeah, the honest answer is we don't know. I mean, I'd love to be able to say that we're going to have a big uptick next week. It's possible that we could be, have this call in 12 months and still be in a similar position. And 12 months from our investment time horizon is relatively short. So we don't know what's going to happen in the next 12 months. That is why we're focused on 5 years plus. So sorry not to be able to give you something a bit more definitive, but we're focused on what we can control, what we think we do best, which is company fundamentals, 5 years plus, and holding on to those companies that we think will do well. And maybe I could just add one thing very quickly, Tom. One of the things we believe in strongly philosophically is the asymmetry of returns. This idea that in equity investing, your downside is capped at 100%, which is not a great outcome. We never want those outcomes, but your upside is in theory unlimited. And there have been holdings which have been really strong long-term performers for the fund, have seen in some cases really severe drawdowns, 45, 50% within their lifetime, or a time of holding them, I should say. But actually, they've still turned out to be some of our best performers over the last 20 years. And I'm thinking companies like Tesla. The other would be Ashtead, which is an equipment rental business, a plant hire and rental business. In the UK, it's seen some quite significant drawdowns over time. But actually, the worst thing we could have done was sell out, because it's gone on to be, a really, really strong performer. So that's another reason we maintain that long-term view, that we've seen this before in our journey, in a long-term investment journey, that companies will experience these drawdowns, but it's not always to say that the investment case is broken. And if anything, it reaffirms, let's keep focusing on the long-term, 5 years plus.
And then someone asks, does your title mean that over the short-term horizon, it's kind of a similar question, do you not anticipate any significant gains in the portfolios? Just to remind everyone, I think the title was why growth investing still matters for the long term. So it's kind of a similar question, but
yeah, I mean, it's fair. I mean, I suppose when I chose that title, it wasn't necessarily to say it doesn't matter for the short term. That subtext wasn't deliberate if it is there, but certainly, we hope that, and we try and be clear that investors in the managed fund should be people that are looking for ultimately long-term capital growth. One thing we don't aim for in this fund is downside protection or managing volatility. For context, there have been 12 occasions in the managed fund's 35-year lifetime where we've seen a 12-month drawdown of 10% or more. Now, clearly that is more severe. This is more severe than that, but we have seen drawdowns that would cause people to actually ask similar questions. And yet the best thing we could do was focus on the long term. So it's not to say that it doesn't matter in the short term manner of speaking, but we tend not to worry about the short term, in all honesty. We're focused on those longer term objectives. And we think that actually growth is particularly compelling on a long term view.
And then another question says, was the fund's underperformance due to overexposure to tech stocks?
Yeah, interesting question. I mean, I've touched a little bit on the presentation on the indiscriminate falls we've seen across the portfolio. That's been pretty sector wide, in all honesty. Now in 2020, I think growth and tech became quite synonymous. You had companies like Tesla. The pandemic stocks were, by their very nature, tech oriented. They were based on cloud computing, e-commerce, and different things. I think what might surprise some people is, I was looking at some of our sectoral exposures not long ago, in fact, and as at the end of last quarter, our most overweight sectors were consumer discretionary and industrials. It wasn't IT. IT was number 3. So, and that's maybe the first thing to point out, that this is not just a tech fund, and growth and tech have been, I think, mislabeled as being synonymous. But what the managed fund offers is exposure across sectors, across clearly geographies as well. And I mentioned IMCD, the specialty Dutch chemicals distributor, and actually Europe is a real hub of niche B2B industrials. NIBE is another one, a Swedish heat pump manufacturer. Now, those companies have been on a real, certainly NIBE has been on a real roller coaster ride. One of the few kind of shining lights in the portfolio and to the end of last quarter, but it's been weaker since. So what we've seen is weakness really across the portfolio. And tech, I think, is becoming increasingly an outdated label, because what company is not technologically aligned? What company doesn't need to be thinking about technology? The internet, in some ways, this was cutting edge, revolutionary technology 20, 30 years ago. And now you don't think of the internet as an edge. And I think tech has kind of gone that way, that technology in and of itself is not something we necessarily look for, but sometimes it's the leverage, leveraging technology to enhance what's going on elsewhere in healthcare and IT, I think is a really interesting one. But sorry, that was a bit of a long-winded way to answer the question. I think the short version is no, it's not just tech, but it's been weakness across the portfolio. But hopefully that context is helpful.
And another question that's come in says, many growth funds have a 5-year time frame in mind. So why has this fund fallen a lot harder than its peers over the last couple of quarters? I guess specifically the last couple of quarters rather than just the last few months. Yep.
So as a reminder for the rest of the audience, the sector the managed fund sits in is the investment association mixed investment 40 to 85% shares sector. We take the median return of that sector and we use that as a broad comparator. Now, I think there are a few reasons that the performance has deviated from the peer group. The first would be clearly at 40 to 85% shares, the managed fund is 75%, so that's a little bit higher than that in equities. So we're the top end of that, and equities have been really the driver of that weakness. I think secondly, our approach is a genuinely growth-focused approach. And I think that's something, in all honesty, over the last 8 years or so that I've been at Baillie Gifford, what I've observed, and I think many people would tell you this, is us really honing in on that approach, or honing our approach and homing in, I should say, on that, and being really unapologetically growth-focused. We're looking for companies that can grow earnings. Now, what some other managers may do would be to say, okay, in the next, let's say, 12 to 24 months, we anticipate that value, if that's even a helpful label, probably not, is a good place to be. So we'll go to the perceived safety of big banks, big oil, and that would have been a good call to have made at the end of 2020 if you could have made it with perfect precision. I think that's a big if. But our approach is so focused on growth. It's focused on companies, which in many cases are not profitable today. Mostly they are, in fact, but in many cases they're not, but they're foregoing earnings today in the expectation of long-term growth. And what we will see is, in the short term, that will mean underperformance at times. And maybe lastly, the managed fund holds directly held 200 equities, 130 bonds. That's kind of ballpark figures, a little bit probably higher than both of those just now. But some other funds in the peer group will be fund of funds, and in some cases they'll hold trackers, for example. So you've just got a fund which could be fundamentally quite different in the way it's put together from the managed fund. So I think those are really the main things. It's a genuinely growth-focused approach that comes hand in hand with a long-termism. It's equity heavy and it's active as well, which does lead to these, typically to more volatility.
And then a quick question from me on top of that. A lot of kind of investment narrative recently has become value versus growth. And as Baillie Gifford, you say you're growth investors. What do you kind of think of that? The general narrative around investing, and how, do you think that's helpful, or how do you think that's kind of changed recently in this environment? And what do you kind of think of that in the press and just people generally with their relationships with their investments?
Yeah, I think we would probably agree in some ways that the growth versus value split is broadly unhelpful. I think, though, I've probably used it today. It's kind of convenient in terms of, you probably know what I mean, but in some ways when I say those. But I think actually stepping away from the broader definitions, what we're focused on in our growth investing is companies that will grow their earnings over time. Now, we've done a lot of manual work on this, and actually the companies which are in the top quartile of earnings growth have been the ones over the last 30 years that have been the top quartile of share price growth. And that relationship is absolutely key. And that is what we're looking for. It's companies ultimately that will grow their earnings faster than the benchmark. Now, I've talked perhaps a little bit flippantly in some ways about big oil and banks. Now, we no sector for the managed fund is off limits in some ways. If we think a company can grow its earnings, and we also think that it stands up to our ESG thoughts as well. We're looking for high standards in ES and G. But we can invest across sectors, and I think sometimes people might be surprised to see companies like BHP in this fund, the miner, or Rio Tinto, or Diageo, the drinks company, which some of these companies are big FTSE 100 businesses, which people assume, well, a growth manager would never touch those because growth is kind of small cap. It's kind of concept stocks, but actually, we've got a real blend of growth in the portfolio. Some are your long-term slower compounders. Some are rapid growth. Some are a bit more concept, and we think that actually the payoff, if it does come through, could be quite extreme. But there are maybe more questions about that. We might have smaller holdings, for example, in companies where we feel the growth opportunity is vast, but maybe the probability is less. And there are other companies, touched on IMCD, that's maybe one. Some of the miners, United Overseas Bank is another one that's held in the developed Asia portion of the fund. And so we're not looking through a universe and just striking off ones that might look like value stocks. But if we think they can grow their earnings, then they're kind of fair game as far as the managed fund is concerned. And if they can meet our growth hurdles, then we'll include them. So the growth versus value split. If you were to sit on our investment floor for, well, probably not even a month or two, but a year, you'd probably rarely hear people talk about that because it's just not relevant to what we're doing at a company level. It's all about earnings growth.
Is that why you think the kind of value growth conversation is sometimes a bit unhelpful? Because after a market shock or correction, value and growth stocks can switch places almost, and what was a value stock becomes a growth stock, and there is that kind of shift. There aren't just set in certain boxes forever.
Yeah, I think exactly, Tom. I mean, I think behaviorally, it's a really unhelpful rule of thumb to have this kind of arbitrary split in our own brains of what is growth and what's value. And that's maybe another reason that it's more important for us, if anything, to reject those. And you're right. Things change, and we don't know what's going to happen in the macro environment. Globalization, is in some ways taking a hit in terms of more protectionist policies in some countries. We've seen the Russia and Ukraine crisis as well, and the effect that's had on energy security and different things. So, the opportunity set can change. I think you're right. And that would be another good reason that, if you've got already your category of value and your own list of holdings that fall into there that you're not going to touch because you think you're not allowed to because we're a growth manager, then, that is potentially limiting you from holding from growth opportunities. So, the split, broadly speaking, the split is unhelpful. It's just unfortunately still can be a convenient way to very quickly break, two categories. But we're still growth focused in terms of fundamental company growth.
And referencing, I think your point about 5 years and looking long term. Someone asked, how confident are you the fund will be positive in 5 years' time from July 21? So from July last year, and why, if you are confident, why?
Yeah, it's a really good question. And we've learned, I think, haven't we, in the last 2-3 years, especially, we can't hold our views too tightly. We do not know what is around the corner. I mean, one of the things I've talked about is optimism, and I want to be clear that it's not a blind optimism. I touched on the asymmetry of returns, and that is the reason really for our optimism. And it's the reason that we're focused on what could go right and not what could go wrong, because actually the companies that could go right, if you can choose a handful of companies that blow the lights out, you can actually you can absorb some of the losses from ideas that straight up haven't worked. I mentioned Vroom. That's an idea that hasn't worked. We sold that holding at loss last quarter. But having said that, you've got long-standing holdings in the fund. I mentioned Ashtead and Tesla. Amazon would be another good example, that have really outperformed and vastly outweighed those things. So I think we have to focus still on what could go right, because we know that if we can get those decisions, even a handful of them right, then that's what will add value over the long term. That's not to say that we're going to say with any certainty what's going to happen with the fund. We can have prolonged periods of performance. I touched on that chart that shows the range of returns, and there has been some 5-year periods where we were marginally underperforming. But on that long-term view, that is where the fund has delivered strength more often than not. So again, I shouldn't feel bad for apologizing so often in some ways, but we just can't be definitive in terms of what is going to happen on a 5-year basis from a given point in time. But certainly we're optimistic. We think the operational growth is really exciting, and that there's no reason to believe that won't ultimately be reflected in share prices. But in the absence of a crystal ball, that's why we're sticking to what we do and what has held together over 35 years plus.
And in the absence of that crystal ball, someone has also asked whether you think we're nearing or at the bottom of the market, and if we are at the bottom, how speedy do you see the recovery? Yeah,
there are signs we might be nearer, but honestly, I think you're probably asking the wrong people in some ways. Things could get a bit weaker depending on what is around the corner. If we saw, and there's a lot of ifs, if the crisis in Ukraine, and it seems unlikely, dissipated very quickly, that might change the game quite considerably. What we're seeing now is the energy transition potentially accelerated. So there's these ongoing changes, and whether or not we're at the bottom and those things it's all up from here is in some ways anyone's guess, in all honesty. What we have seen, for what it's worth, is on the institutional client side at Baillie Gifford more broadly, is people adding more to growth equities. Clearly there has been a big sell-off. Some individual companies are off 75%, or thereabouts. Real quite extreme weakness for a company that is doing particularly well. So some people I guess you could take that how you wish. Is that a sign that some others are calling the bottom? Maybe, but I certainly, and we as a firm, wouldn't like to be seen to be calling a bottom. And we're just focused on, sticking to the knitting, focused on the day job of seeing, does our investment case, our forward-looking hypothesis, hold together from here? And if the answer is yes, then we'll continue to hold. We might even add. We might yet see the weakness before such a time as we see strength come through. But again, that's that. We're not trying to smooth returns. We know that some of the best performers of this fund have been really volatile over time, and it would be remiss of us to get too fixated on that. And it's ever so important that we focus on the long term plus. I'm sounding like a broken record saying that, but it really does. That is the bedrock of our philosophy.
And you mentioned adding to positions there. Have you used this market downturn as an opportunity to add to any certain positions with cheaper valuations?
We have, yeah. I think I mentioned Auto One, the German car manufacturer. I think another one that's interesting, a slightly more recent add, is Process. It's going through various challenges. For those that don't know, its biggest holding is Tencent, and actually its holding in Tencent is bigger than Process itself. So that's a company we feel has ultimately been really undervalued by the market. And it is one we also decided to add to. I think, though, the challenge that we've got just now, or at least that we've had in a period of more pronounced weakness, is what do you add to? If you have weakness across the portfolio, let's say the US portfolio, where the vast majority of holdings have been weak, then what is going to be your source of funds for an addition? And it is very difficult when you're looking at it in that way. But we have been adding on weakness, Process and Auto One. Another is Allegro, which is actually a newer holding for the fund. It's a Polish, it's kind of Poland's answer to Amazon. And in many cases, these businesses are profitable, they're doing well. In this case, Allegro's been kind of not so much implicated, that's a poor choice of words, but the effect of Russia and Ukraine has been seen. It had some Russian subsidiary businesses that it's since written off. But the market has been, there's been a kind of state of hysteria in the market that any news that's announced, share prices can really jump all over the place. So we do take opportunities where we can and where we think we've got that it's a good time to do so, but it's not to say that if everything's down, we'll by default just add to everything I mentioned. We want to take a step back. Maybe we're missing something. So it's company by company, case by case, and it's possible that as things stabilize a little bit, as we get a bit more of a sense of what the future might hold, then we might continue and to add to holdings that if they remain weak. But it's something that it's an ongoing part of our process, is adding to holdings that have been weaker if we think that actually that's the operational growth is absolutely still intact and there's plenty to go for.
We've got a couple more minutes, so I'll throw two more questions over to you. Someone's asked the interesting question of what would you tell a client who's lost more than £50,000 due to their exposure in the Baillie Gifford managed fund? I guess more a behavioural question. Yeah,
I mean, I guess the first thing is we really don't want to. That's not the kind of the returns that we want to deliver. We fully appreciate that it's been a really, really difficult time and it has hit people's savings. Now, one of the challenges, I suppose, of being a long-term investor is if you've not been in the managed fund, if you've not been in the fund for 5 years, then you don't have the benefit of that longer-term performance that kind of holds you up potentially a little bit more. And I think it is really difficult. I mean, we, for the record, can't give investment advice. So, we don't have those sorts of discussions where someone says, here's what's going on, and particularly the question of what should we do about it. We're ultimately a discretionary manager, but for us it's about maintaining that long-term view, and we really do feel that pain in some ways. Many of us at Baillie Gifford hold the managed fund in our own SIPs and other Baillie Gifford funds, so we feel that pain in a very real and personal way to that extent as well. But it's about that long-term view, and we know that for some people, people that want short-term smoothness in returns, this fund won't be suitable for them. We need to be upfront about that, but yeah, it's been a really difficult time, and it's trying to, I think, bed in and keep the long term in mind and see some of the operational progress that we're seeing in some of the reasons for optimism, but reading in other people's own objectives and tolerances around volatility over the short term. But yeah, it is a difficult question, and all I can say really is that we really share that, and all we can promise is that we'll focus on what we can control, which is our long-term view. That's what we're set up as a firm to deal with, and so that's what we'll continue to do, and keep clients' long-term interests in full view.
One final question. I'll give you about 30 to 45 seconds to answer it. Someone's asked, the fund has seen one of the greatest outflows over the last 3 months in its universe. I don't know if that's true or not, but we'll take the question. What effect is this having on the underlying assets, cash holdings, and is it hindering returns and investment decisions?
Yeah, I mean, this is still a big fund. It's about £6.4 billion sterling. And you're right, we've seen some outflows. So that's on the back of in 2020 and 21, more than £1 billion in net inflows in both of those years. But it's not affecting liquidity. It's a diverse fund. The biggest positions are typically going to be no larger than about 2%. So no issues on the liquidity front. And we do have about and today it's going to be just under a 3% roughly cash balance. So we're able to meet redemptions without any difficulty. So that's not having an effect on our ability to meet redemptions. We do the liquidity analysis too on an ongoing basis, and certainly that we're getting the green light on all the measures that we would look for. But we've got no reason to believe that from here, A, that we can't maintain that long-term view, but B, that we'll not be able to honor client redemptions if and when that was required. So hopefully I kept that in 40 seconds, did I? Just about.
Just about. Well, thank you anyway, Phil. That was a really fascinating presentation. So thank you for your insights, and especially in what was a pretty lively Q&A session there. So now, before we wrap up, let's just get those learning objectives back on the screen. I won't read them all out, and I'm sure Ben has achieved them. Anyway, thank you. That's all we have time for today, sadly. So thank you for your questions, and thank you again, Phil, for joining me, and of course for letting me and the folks at home grill you with all those questions. On that note, if your question didn't get answered, Phil and Baillie Gifford will do their best to do so after the event. And before I close up, I should assure you your CPD will be delivered tomorrow. That's it for PA's H1 events. I hope you've enjoyed the series so far. We're taking a break through the summer now, but PA will be back again with a busy program starting in the early autumn. For myself, however, This is sadly my last day with Professional Advisor. I'm moving to join the Landcat, and there'll be a new editor in place when our events kick off once more in September. But let me leave you, therefore, with a teaser of what's to come. Anyway, so on the 10th of August, we'll be running the next in this year's series of Professional Advisor Working Lunches, where we'll be back with another presenter from Baillie Gifford. We'll be announcing the subject of the session in the next week or so do look out for details on that. And September sees the start of a packed event schedule for PA as we launch our inaugural Scotland and Northern Ireland Investment Roadshow, where we'll be visiting Belfast, Edinburgh and Glasgow on the 6th, 7th and 8th of September, respectively. Do come along to hear presentations from HSBC Life, Orbis, Pictet, Simply Biz, and one more speaker to be announced shortly. Our keynote speaker for the roadshow will be Jock Glover, COO of Square Mile Investment Research and Consulting. And then in the following 2 weeks, Pierre will be back with an autumn multi-asset roadshow on the 13th, 14th, 15th, 21st and 22nd of September, where we'll visit Harrogate, Knutsford, Birmingham, Bristol and London. And you can hear updates from the likes of Baillie Gifford, Orbis, Pictet and 2 more to be announced shortly. And our keynote for that roadshow is the ever opinionated Managing Director of the Advisor Centre and an old friend of PA, Peter Toogood. All in all, that's a total of 9 hours CPD for you. So that's it for today's session. Thank you again, Phil, for your presentation and answering the questions. But of course, our biggest thanks goes to you, our readers, for your company this lunchtime. I trust you found this session helpful and worthwhile. Enjoy the summer break wherever you're travelling to, and we look forward to seeing you again in the autumn. Goodbye.